they just blew up the $250,000 limit. Forget that. I mean, I know what the statute says, but they threw that out the window. The moral hazard, the economic consequences, the repercussions of this are kind of unimaginable. I mean, I can sketch them, I can talk about them, but this is, to hear Jenny Ellis say it's not a bailout. Are you kidding me? This is the biggest bailout in history.
It's a global crisis, a ticking time bomb waiting to explode. Is this the one crash that will shake the very foundation of the economy? Jim Rickards has something to say.
What happened was, as soon as they announced the loss and Moody's did the downgrade, you should have been ready to close the deal right then, like the next day. It's like, okay, and by the way, here's the $2.5 billion. They didn't, and then there's a lot of, there's the market risk we described, but there's just a lot of gross incompetence at Silicon Valley Bank. They had, we're talking about risk management right now. They had a vacancy in the risk management officer. There was like 6 months or more. Nobody was in the position. They weren't thinking about it. And then at least, and there were some good lawyers. And Sullivan and Cromwell, they represent Goldman Sachs. There was some good lawyers involved, but Silicon Valley wasn't even ready to sign NDAs. Like the potential investors were like, okay, we'll take a look, sign this NDA, and give us all your books and records. And by the way, this is hairy, so it's going to take a couple days. Why wasn't all that done, a week prior or longer? And why wasn't SVB able to get their lawyers to stay up all night and do the non-disclosure agreements?
Numbers don't lie, and these numbers? Soaring. With debt ceiling up like never before, it's not a question of if, but when it will all come crashing down. With a track record of precise prediction, Jim Rickards is not one to be taken lightly. His is a name synonymous with economic foresight.
So they bungled it, they lost the opportunity, and then Peter Thiel says, get all your money out, and other VCs. I'm not blaming Peter Thiel. That was actually a very smart thing to say. But then it was just over before Goldman could get the deal done. Government takes it over on Friday night. Now, here's where it gets really interesting. The government press release from the FDIC said, okay, actually it was the state of California shut them down, appointed the FDIC as receiver. FDIC sends a press release on Friday and says, okay, we're in charge. But the press release, and I read it closely, it was interesting. It said, okay, well, all deposits of $250,000 or less, you're fully insured, you're getting your money, it'll be there on Monday. Everybody else is wiped out. That your deposit is gone, not just frozen, but gone. They gave them what they call a receivership certificate. So here's like an illiquid IOU. And you say, well, what's that worth? And the answer is, we don't know. We have to sell assets, and then we'll pay off creditors, including yourselves, and you'll get something on your receivership certificate. It's like, yeah, is it 10 cents on the dollar, 90 cents on the dollar? No one knows. I mean, you can guess, but they don't know until they sell the assets. And having gone through this with the Resolution Trust Corporation in the early 90s, that can take 6 months, a year. It actually took, I think RTC did a good job, but that took 2 years from kind of 90 to 92 to clean that up. So you actually don't know. Meanwhile, who's got the receivership certificate, who used to be a depositor? All these startups we talked about. Well, I don't care if you have 25 employees and $2 million in working capital. You got a payroll. You got to pay the rent, pay the employees, pay the vendors, pay the developers, the coders, et cetera. And they couldn't because their money was gone. So now they were just going to sequentially and very rapidly fail. They were going to, file for bankruptcy or close their doors because they literally couldn't meet payroll. And this is where the White House got involved, because then they're like, all these techies, all these, and then you have tech startups, we talked about that, but who owned the tech startups? Well, this is where you get into the Bill Ackmans and the, Peter Thiels and Larry. You get into all these big players who own all these little startups, Kleiner Perkins, Google, whatever. Well, who are they? They're very heavy Democratic donors. And what were these startups doing? Well, everyone thinks, I must be working on a new app. That's not true. A lot of them were climate-related, sustainable resource startups. They were working on the Green New Deal. And by the way, it's not exactly a viable business model, except if you look at the Inflation Reduction Act that Nancy Pelosi pushed through last August 2022, that was about 800 billion, a little bit more, maybe 900 billion. But that was called the Inflation Reduction Act, which was nonsense. That was the Green New Deal. That was the Green New Deal that AOC wanted from the start, and not all the money, but well over $200 billion was available for rebates, tax refunds, tax credits, etc., for people doing work in so-called sustainable resources, and many of them were. Now, we don't have 5 hours to talk about why the Green New Deal is the Green New Scam. That's a separate topic, but but there's no doubt that the White House favored it and the Democrats favored it. So not only do you have Democratic donors, but the clients of Silicon Valley Bank were working on projects that are completely favored by elites, Democrats and Republicans, and a lot of their business models were based on getting these tax credits. So all of a sudden, you were not just blowing up a bank and the tech startups, you were blowing up a lot of initiative in the climate change arena, which again, I have a low view of that, but doesn't matter. The White House thinks it's great. So the ripple effects of this went on and on. There were something like 500 Israeli startups that would have been potentially put out of business. There were several hundred UK startups that petitioned the Exchequer, to get a rescue of the UK branch of Silicon Valley Bank, Chancellor of the Exchequer. So this thing was all of a sudden rippling all over the world. There were a lot of elite interests that were threatened, and so Sunday night, and I have to say, I've studied this very closely. I know a lot about banking. Sunday night at 6:15, the Fed, the FDIC, and the U.S. Treasury came out with a press release. They said, "Just kidding. The deposits are good. It's all good. We're going to guarantee unlimited." So now you're talking, oh, it's not 250,000. It's 5 billion in some cases, or $2 billion in other cases. And they said yes. And so it was a 180-degree turn from what the FDIC said on Friday. It was like, deposits are dead. It's like Dracula back from the grave. The deposits are alive as of Sunday night.
Markets in turmoil. Jobs are on the line. The economy spiraling into chaos. Bad debt that brings nothing productive. History has a funny way of repeating itself. What to do? It's time to double down. Invest wisely, diversify, and don't be caught off guard.
And not only that, but the Fed proceeded to guarantee every deposit in every bank in the entire U.S. banking system. Here we're talking, $6 or $7 trillion of assets. Go back to 2014, Brisbane, Australia, the G20 finance ministers. They had been wrestling with the political fallout and the blowback from the 2008 rescue, because, without reliving the whole 2008 episode, that was basically using taxpayer money to bail out all the banks. They all, Bear Stearns and Lehman went down, but everybody else, they got to keep their jobs. They got bonuses in 2008. Their stock price fell, but then it went back up again. There was no accountability. Nobody got nicked. Everybody kept their jobs, kept their bonuses, kept their stock. It all went back up again, and all done with taxpayer money. So the taxpayers are like, wait a second, I lost my job, or my business failed, or my cousin's out of work, whatever, but you took my tax dollars and bailed out Jamie Dimon, John Mack, and the heads of Goldman and Citi and all the rest. So there was enormous political fallout from that. So the G20 was like, well, what do we do about that? There will always be another failure. And of course, they're right. So in Brisbane, they switched. They said, no more bailouts. From now on, we're going to have bail-ins. And what's the difference? Bailout is when you use taxpayer money and you bail out the depositors and stockholders. A bail-in is when you turn to the bank and say, no, we're going to fill the hole in your balance sheet with depositor money. The depositor is at risk. We'll pay the insurance amount. It's 250,000 US, 100,000 euros in Europe. So we'll pay that, but that's it. And we are not bailing out any depositors or note holders or anybody else. We're going to haircut them until the hole in the balance sheet is filled. And then if there's anything left, you can have what's left. But everything else is at risk. We're not going to the taxpayers. We're turning to your depositors, and they're going to suffer, and they're going to pay the price. And that was the bail-in rule. Well, it turns out, and that was 10 years ago, 9 years ago, there were no major bank failures between 2014 and last week. Little ones, but nothing systemic. So they came up with this new bail-in philosophy in 2014, but it had never been tested. It had never been used. This was the first time that a government agency, in this case the FDIC, said, yeah, bail-in is the new law of the land, and we're gonna whack the depositors to make up for the losses. Well, that lasted exactly 48 hours till Sunday night. So here you have a 9-year rule. Oh, we're no more bailouts. Boom! Within 48 hours, they flip and they do the biggest bailout in history. So they have no credibility. The FDIC fund is going to be seriously depleted. The idea that the taxpayers don't have to pay is nonsense. Why? Because you're going to deplete, since you took away the $250,000 ceiling on deposits, you're going to deplete the FDIC fund, the insurance fund, to pay off all these claims to, Roku and Box and all these people. So how are you going to replenish the fund? Well, they're going to increase the insurance premiums on the banks. Okay, well, the banks are going to pay that, but where are they going to get reimbursed? Well, they're going to charge the customers fees, or they're going to pay you less interest. In other words, it comes out of the pockets of everyday Americans no matter what you do. You can launder through the FDIC and the bank insurance premiums, but at the end of the day, the banks are going to charge the customers, and so you're paying for it at the end of the day. So this, apart from the bailout that I described, this was a complete repudiation of 9 years of fiction that somehow depositors were going to get bail, that would be, would pay the cost of a so-called bail-in. No, they're just back to the bailout. And I was having a discussion with my editor, my managing editor of one of our publications, Strategic Intelligence, and we had, you work a little bit in advance, and I planned to write something for our April issue on climate change. It's a big subject, and I had outlined it. And he said, Jim, we got to do this banking crisis. I said, of course, let's put climate change down the road. We'll work on the banking crisis. So I started researching and writing on Silicon Valley Bank. And then I'll get into more detail, but 2 days later, they took over Signature Bank. So, well, we got two banks now. We got to, zero in on this. There was a crypto connection and Signature. We'll talk more about that. And then the next day, First Republic hanging by a thread. It's still hanging by a thread, by the way. Again, we'll go over all this in more detail. And so I couldn't write fast enough because as I'm writing, the story is unfolding. And then you get all the corruption, insiders selling stock before the crash. Mary Daly, the chief regulator, president of the Federal Reserve Bank in New York, she's running around doing LMNOP plus and pride flag and all this stuff. Fine, that's, it's a free country. You can do that if you like, but she wasn't running the bank and she knows nothing about risk management. She's a labor economist, protege of Janet Yellen, came up the ranks, but knows nothing about risk management or actually running a bank. So it just got worse. And then here comes Credit Suisse, right? The one thing I know, maybe a little before your time, Brian, but there was a very, very popular rock celebrity writer in the 1960s named Marianne Faithfull. She had a great career, lots of hits, Mick Jagger's girlfriend, etc. But her summary of the 60s, she said, if I wasn't there, it didn't happen. And I thought that was a very, very good way to put it. In her case, that was true. But I started to feel that way about financial crises. If I wasn't there, it didn't happen. I go back to the Herstatt Bank collapse in 1974, which was a shock. That was back before, that was a foreign exchange crisis, but it highlighted the fact that when European banks closed and the U.S. banks were just opening, if you had a failure here, it never settled over here. It wasn't real-time settlement. So there was just all these open positions of a bank that had just failed. The S&O crisis in the 1980s, the Latin American debt crisis, the early to mid 1980s, the flash crash in 1987, the Mexican tequila crisis, 1994, long-term capital, Russia, 1998. Of course, I negotiated that bailout, dot-com crash, 2007 mortgages, 2008, everything falls apart, 2020, COVID, and now today. So I don't know if I'm a magnet for trouble, but I've seen my share of financial crises. And as an analyst, they have certain things in common. The entities are always different, the currencies are always different, but the dynamics are very much the same. And the one thing I can say to our viewers is that this is not over. There's been a little bit of a sigh of relief. Stock market rallied a little bit toward the end of beginning of April. And okay, that's a normal reaction. But any thought that the problem's been solved, the bailout's complete, you're not going to hear more, is just not true. There's more coming. Get ready for it. I can't tell you. I'm not going to pick a specific name, and we all know the names of the big banks that might be in distress. Is Deutsche Bank or Barclays or HSBC, Santander. I'm not picking on any of them. I'm just saying that there are more dominoes waiting to fall. The really interesting part about this, and again, we can come back to the specifics, is that The dominoes falling is a good metaphor. It's, if you got 100 dominoes, you knock the first one, they're all going to fall. That's just physics. So how do you stop that? How do you stop that crisis? Well, you truncate, you drop a steel wall between two dominoes, and this one hits the wall, and this one's still standing. But that's the bailout. But the problem is each crisis tends to get bigger than the one before, which means each bailout gets bigger than the one before. My question that I'm wrestling with: are we now at the point where the needed bailout is bigger than the capacity of the central banks? That they've pulled all the rabbits out of the hat, played all their cards. And again, this goes back to what I did say about the Silicon Valley Bank rescue. It is the biggest bailout in history, and I can explain why. But if that's the case, and what else do they have? And then, so now we're dangerously close to the point where, as the crisis gets worse, it's no longer, oh, gee, let's wait for the Fed to bail it out, or let's wait for the ECB to bail it out. You get to the point, I think we're there, where you say, no, these guys actually can't stop it. And you lose confidence in the currency itself. It's the dollar. The crisis is the dollar itself, and the euro, goes along with that. And then that's the crisis. And there's no way to bail out a dollar crisis with dollars, because you're just pumping more of what people have lost confidence in. And then, then where do you go? And there are good answers to that. We've seen it again. We've seen it all before, but you have to kind of take the timeline out to 1,000 years, or the 1350s with the failure of the Bardi and Peruzzi banks in Florence, to see how these things can really play out. So this is big. It's not over. The regulators will attempt more bailouts, but we're at the point where I think you can start to question the regulators themselves.